In 30 seconds, let's see how Warren Buffett answers a question asked to him in 2015 shareholders meeting.
Mr. Buffett, you identified 4 books that you particularly cherish. 3 of these books were authored by Graham himself. The contributions of the 4th book to your thinking, however, that book was Adam Smith's The Wealth of Nations, published in 1776. So my question is, what did you learn from The Wealth of Nations, and how did it shape your investment and business philosophy?
Well, it doesn't shape my investment philosophy, but I certainly learned economics from it. And my friend Bill Gates gave me an original copy of it. No, I was able to study it as Adam Smith wrote it in 1776. There's just, if you read Adam Smith, you will have a lot of wisdom.
And this is what his right-hand man, late Charlie Munger, had to say about it.
Adam Smith is one of those guys that's really worn well. I mean, he is rightly recognized as one of the wisest people that ever came along.
In a time when wealth was thought to be controlled by a select few kings, government and emperors, Adam Smith dared to dream of a world where individuals, driven by their own ambitions, could create prosperity for all. This back then was a radical notion, and in 1776, he poured his revolutionary thoughts into The Wealth of Nations. This book would become the cornerstone of modern economics, so much so that though Adam Smith died in 1790s, however, still he is called as the father of modern economics. Actually, he must be forefather, considering he walked this earth more than 230 years ago. He was read by all famous philosophers, academicians, professors of the 19th century, revealing how freedom, trade and competition could lead to unprecedented wealth and opportunity. The principles Smith outlined in his masterpiece changed the course of economics. These aren't just dusty theories. They hold the keys to understanding today's complex financial landscape and your path to successful investing. This is The Better Investor, helping you achieve your financial goals and freedom by diving deep into investment and financial classics, and these are top 5 lessons from the book The Wealth of Nations, written by Adam Smith. Lesson number 1: The power of division of labor. Imagine a time when everything had to be handmade, when blacksmiths made nails one at a time, or cobblers stitched each shoe by hand. Smith argued that if you split a job into several specific tasks and assigned them to specialized workers, production would skyrocket. Let's take the famous example from Smith's own book, A Pin Factory. If one person tries to make pins from scratch, they might make 20 pins in a day. But when 10 workers specialize, each focusing on tasks like drawing out wire, cutting it, sharpening, assembling and polishing it, they can make over 48,000 pins in the same time. Smith's insight goes deeper than just factories. He was saying that specialization and efficiency are the energies of the economic growth. Every time a company or an industry divides labor, it unlocks potential for greater productivity and lower costs. Think about a modern day example, the production of smartphones. Apple doesn't manufacture every single component. It outsources to companies worldwide, each specializing in different parts, from microchips in Taiwan to screens in Japan. By focusing on their strengths, these specialized companies make components cheaper and better than Apple could alone, which results in affordable yet advanced products for customers. This is division of labor in action. For investors to take away, it is important that when analyzing a company, look at how well it leverages its division of labor. Companies that effectively specialize and outsource tend to be more efficient and scalable. Think of Tesla, which initially tried to manufacture everything in-house but has now partnered with suppliers for specific parts, allowing them to focus on innovation. Division of labor isn't just a principle for factories, It's the framework that fuels the most successful companies today. Lesson number 2, the role of self-interest. Self-interest, according to Adam Smith, isn't about taking from others. It's about striving to succeed, and in doing so, creating opportunities that benefit society as a whole. Let's explore this with an example. Imagine a local restaurant owner who's passionate about making the best food in town. Why does she do it? Primarily, she wants her business to thrive, earn a profit, and gain a loyal customer base. She's pursuing her self-interest. But here's the interesting part. By focusing on her goal, she ends up providing delicious meals, creating jobs for cooks and servers, and contributing to the local economy. The restaurant owner's drive to succeed doesn't just help her, it ends up creating value for everyone around her, often unintentionally. In Adam Smith's view, self-interest is a positive force because it drives people to work hard. Entrepreneurs motivated by their own goals push boundaries, innovate, and ultimately bring more choices to the market. When people strive for success, they raise the bar for everyone around them. Now let's consider the opposite situation, a manager in a government-run company. Unlike the entrepreneur, this manager's self-interest is limited. Often, he has no stake in the company's long-term success, no stock options, no direct ownership, and crucially, no skin in the game. He knows that after a couple of years, he'll be transferred to another government post, regardless of how well the company performs. There's little personal incentive to innovate or drive growth, because his career is more or less secure. With no deep-rooted self-interest, the manager's motivation to improve the business is naturally lower. And without a sense of ownership, there is limited accountability. This is why Smith believed self-interest is crucial for real economic progress. When there is no direct connection between personal success and company success, as often seen in government-run enterprises, the drive to work harder and create better product or services tends to fade. For investors, this is a key insight. Companies led by ambitious, driven leaders tend to be innovative and resilient. When founders or CEOs have skin in the game and are deeply invested in the success of their businesses, they're likely to work harder and make smarter decisions. A company motivated by strong self-interest, especially when aligned with consumer needs, can lead to a significant growth and long-term value. In Smith's eyes, self-interest isn't just about personal gain, it's about striving for excellence and in doing so, creating a ripple effect that benefits us all. Lesson number 3, value of goods, use versus exchange. So here's the idea. Just because something is useful doesn't mean it's valuable in a marketplace, and vice versa. Smith illustrates this with the famous water and diamonds example. Water is essential for life, but it's generally cheap because it's also abundant. Diamonds, on the other hand, aren't essential for survival, but they're extremely valuable because they're rare and highly desired. What Smith teaches here is that market value is determined by scarcity and demand, and not just usefulness. For investors, this is a huge lesson. A company might make an incredibly useful product, but if there isn't strong demand or scarcity, it won't generate much value in the market. For modern example, look at streaming services. Access to Netflix with thousands of shows and movies is only about $15 per month. Yet, people will pay thousands for rare limited edition sneakers. The sneakers don't have utility of Netflix, but scarcity and brand create higher value. Also for modern investors, Smith's insight can be a powerful tool for identifying promising investments. Here are some key takeaways. First, don't overvalue utility alone. Just because a product is useful or practical doesn't mean it will generate high market value. Second, consider brand and exclusivity. Companies that successfully cultivate brand appeal and exclusivity often hold higher valuations. Think of companies like Apple, which has built a brand that encourages demand and loyalty, even if there are cheaper, equally functional alternatives on the market. Number 3. Evaluate scarcity as a strategic asset. Tesla's strategy to produce limited vehicles or Nike's decision to release limited edition sneakers taps into this principle. Number 4. Embrace the power of psychological demand. People value items that they can't easily access, even if those items aren't useful. Understanding this psychological component can help investors identify markets where exclusivity or limited access can lead to a higher return. Lesson number 4. The invisible hand. From long back during king's time and thereon, it was a common belief that it was the job of the king and then the ruler to regulate the markets. And it actually happened like that since a long time. But Adam Smith had a different turn to things. He said that the best way so that everyone benefits is not regulation but free market. When the market is free and without any regulation, the intense competition forces company to allocate capital in most efficient way so as to provide the best product to the customers. The inefficient players which are not able to keep up with customers' expectation in the most efficient way are eliminated as they find no business, and thus in a way over time everything balances out. For example, for many years India's taxi industry was tightly regulated. To operate legally, taxi drivers needed special permits, which were limited in number and often difficult and expensive to obtain. This regulation created two main problems. First, limited taxi availability. Because there were only so many permits, cities like Mumbai and Delhi had fewer taxis on the road than were needed, leading to frequent shortages. And number 2, high prices. With limited competition, fares remained high as drivers could charge premium rates due to scarcity. When ride-hailing services like Ola and Uber entered the market, they worked in a regulatory grey area, connecting drivers directly with passengers without the need for traditional taxi permits. Suddenly, more drivers could offer rides, leading to better availability and more competitive pricing for consumers. However, initial resistance from the government and taxi unions led to debates and temporary restriction in some cities. In a free market, each person or business acting in self-interest drives the economy forward without any centralized control. It's like a dance with no choreographer, yet everyone somehow stays in rhythm. By allowing the freedom to pursue individual goals, the invisible hand guides resources to where they're needed most, creating prosperity for all and society as a whole. Lesson number 5. The role of government. When and why to intervene. While Adam Smith believed in free markets, Smith also saw a need for government in specific areas. According to him, the government should focus on 3 things, that is, protecting society, providing justice, and creating public works like basic education and healthcare services that private companies wouldn't find profitable. Imagine if every rural road in the village were privately owned. The cost to use them would be astronomical and it would limit people's movement. By funding essential infrastructure, the government ensures that society functions smoothly. Look at the renewable energy. Solar and wind power are essential for sustainable growth, but they aren't immediately profitable. Governments subsidize these industries to make them viable. As investors, recognizing sectors supported by government intervention like clean energy can reveal lucrative opportunities. Smith's lesson here is that while markets are efficient, they have limits. By stepping in where markets fall short, governments help build infrastructure that supports long-term economic wealth. To summarize, specialization in tasks boosts efficiency and innovation, powering economic growth. Personal motivation drives people to work harder and innovate, indirectly benefiting society. Market value comes from scarcity and demand and not just utility. Self-regulated markets enable individuals pursuing personal gains to benefit society unintentionally. Governments must ensure markets are free and fair. Other than that, the only ventures government must step in is to ensure good defense, justice, basic education, healthcare and public infrastructure. That's it guys. If you like the video, please like, share and subscribe. I will see you soon in another video. Until then, cheers guys.